happens when a multi-brand restaurant empire with thousands of locations files for bankruptcy. And what does that mean if you are an investor or thinking about buying one of their franchises? Let's talk about Fat Brands. Fat Brands, the parent company behind names like Fatburger, Johnny Rockets, and Round Table Pizza, has officially filed for Chapter 11 bankruptcy protection. And shortly after that filing, they were notified that they will be delisted from the Nasdaq stock exchange. So what happened? Fat Brands built a portfolio of about 18 restaurant concepts with more than 2,000 locations worldwide. Over the years, they expanded aggressively through acquisitions, buying multiple restaurant chains and growing fast. But that growth came with heavy debt. As financial pressure mounted and liquidity tightened, the company filed for Chapter 11. That does not mean restaurants instantly shut down. It means the company is asking the court for time to restructure debt, negotiate with creditors, and stabilize operations while continuing to run the business. However, the filing triggered another major consequence. After the bankruptcy filing, Fat Brands received notice that it no longer meets Nasdaq listing requirements. As a result, its stock will be delisted and is expected to move to an over-the-counter market. The company has said it does not plan to appeal. For investors, that is significant. When a company enters bankruptcy, shareholders are often last in line. Dilution is common. In some cases, equity can be wiped out entirely, depending on how restructuring unfolds. For franchisees, the impact is different but still real. Yes, locations may stay open, but during Chapter 11, priorities shift. Marketing budgets can shrink. Technology rollouts slow down. Vendor relationships may change. Leadership can turn over. And franchisees are still locked into long-term agreements while that uncertainty plays out. Food franchises can look safe because the brand is recognizable. But restaurants are one of the hardest businesses to run. Thin margins, high labor costs, volatile food prices, expensive build-outs, and if the franchisor carries significant debt, that risk does not stay at corporate. It trickles down. When you buy a franchise, you are not just buying a logo. You are tying your future to the financial strength and leadership of that company. A big brand does not automatically mean low risk. If you want help analyzing a franchise before you invest, that is exactly what we do. Subscribe for more breakdowns like this, and I will see you in the next video.